If your goal is to get approved for a 50,000, 75, 100, even $250,000 in business funding, whether that's in the form of business credit card, a term loan, or business line of credit, and you keep getting denied, or you get approved but you're totally underfunded, then you need to watch this video. Because the number one reason why small business owners are getting denied has nothing to do with their business, and it's actually how their personal credit is structured. And look, in this video, I'm about to break down exactly what it takes to be able to build out a perfect, indestructible credit report so that you can be able to get approved for over $250,000 in the next 90 days. Let's get into it. First, let me explain something a lot of people get confused. If you're a brand new business, I'm talking about a business under 2 years old, and you're applying for business funding, your business is not old enough for it to stand on its own. So when you go to a lender to apply for funding, they're going to be judging you because your business does not have enough credibility. So when they judge you, they're going to be looking at your personal credit, because unfortunately for the first 2 or 3 years of business, your business technically does not have enough credibility. Does not have enough data built up so that lenders can be able to make a risk assessment. So because they don't have that, they're going to be looking at your personal credit report, which is going to be considered your financial reporting. So they're going to be looking at your credit profile, not just your credit score, but your whole profile, what is actually being reported on your credit. Because at this point, your credit report is seen as your financial report card. And it's just like school. The more A's you get, the more funding you're going to get approved for. A credit report is going to show everything that a lender needs to qualify you or deny you for funding. It's going to show exactly how well you've been able to pay things in the past, what type of accounts you have, and whether you had any derogatory, late payments, or anything of the sort. And by looking at your credit report, there's going to be 3 things that they're going to be deciding. Number 1, whether to approve you at all. Number 2, if they do approve you, how much are they going to approve you for? And now number 3, if they do approve you, what type of interest rate they're going to approve you for. And look, y'all, this is where it gets really important, because the 3 credit bureaus, Experian, TransUnion, and Equifax, look, they track all of that. And look, these guys need to be your best friend, because they are single-handedly going to be the reason why you get denied or approved. And look, y'all, I can't stress this enough. It's so important to understand how these credit reporting agencies are reporting information on your credit report, because that also determines which lenders are going to approve you, because some lenders only pull from 1 credit bureau, some pull from 2, and then some pull all 3. So by better understanding how your personal credit report and how it's structured is going to determine how much you get approved for, and whether you get approved or not, it's going to be a game changer. So that's what we're going to be talking about today. I'm going to break down the top 6 pillars that you need to have dialed in. All right. Pillar number 1, this is what everybody knows about. This is your credit score. Ideally, you want to have above a 720. So if you watch any of my other videos, you probably heard me go on and on and on about that. It's just not about your credit score. And that's actually correct. But your credit score is still going to play effect. Now, we can't lean too much on a credit score, but a credit score is going to give you a general idea of how strong or how healthy your credit report is. Generally, the higher the score, the better credit report. Of course, there are some times when that's not true, but generally, the higher score, the better you're going to get approved. And typically, you want to be at a 720 or above. Now, let me be clear. Even if you don't have above a 700 credit score, you can still get funded. Here at TFS Funding, we fund clients even as low as 680. But typically, the higher your credit score, the better terms you're going to get approved for. So for the people who have an under 700 credit score, what can we do about it? Generally, there's 2 big things that if you fix, your score is going to increase. 1, that's your overall credit utilization. And then 2, that's whether you have late payments, charge-offs, collections, making sure you get those removed from your credit report. And we're going to talk a little bit more about that later on in the video. We're going to talk a little bit more detail about that later on in the video, but just generally know, get a 720 and above credit score before you aggressively start applying for funding. Pillar number 2, keeping your credit utilization under 10%. And look, y'all, I know how the economy is. It's hard to keep your credit card debt down, but I've seen it be the number 1 reason why people get denied. I've seen people with 790 credit scores having high utilization and getting denied funding simply because of that. So here's how credit utilization works. Every revolving credit, we're talking about a credit card or a line of credit, they're going to give you a set credit limit. Your utilization is the ratio of how much debt you have on that total credit limit. So if you have a $10,000 credit limit, you use $6,000 of it, your utilization is going to be at 60%, but which is kind of high. You want to be able to get that down. And look, you probably heard online it's best to keep your credit utilization under 30%, which is true, but just keeping it under 30% is not going to hurt you, but it's also not going to help you when it comes to getting funding. You really want to be under 10%. And the reason why this is so important, because if they see that multiple credit cards are maxed out or have a high utilization, the lender is going to look at you like you're not able to handle the funding that you've been already given. So why would they give you more if you can't handle what you already got? It makes you look like you're in distress. And lenders don't like to lend out to people who are in distress. So the question is, what do you do if you have high utilization on your credit card? So there's two ways to be able to resolve this. The first one is the obvious, use more cash to be able to pay down their credit cards, but easier said than done, right? The next one is actually hiding your credit utilization. There are online banks out there like SoFi, Happy Money, Credibly, where they will approve you for a personal loan that is dedicated to paying off your credit cards. And now these are not typical personal loans because these loans are not going to go into your bank account. They're going to pay off your credit card. So now your credit utilization is going to decrease, your score is going to increase, and now you are in better position for funding. But look, I understand you might be thinking, Julian, why would I use one debt to be able to pay off another? What if I told you that these personal loans can go as low as 6 to 7% while your credit cards have an interest rate that go up to 28%? So not only are you paying down utilization, increasing your score, but now you're also saving money on interest. So when you pay down the utilization, so now the debt does not disappear, but it gives you a little bit more breathing room to be able to pay off that debt over time. Also, we have to understand that personal loans or installment loans don't affect our credit score the same way revolving debt does. So basically, we're transforming our revolving debt into an installment debt. And look, people underestimate the power of just paying off a credit card. I've seen scores jump up 60, 80 points just within 30 days just by paying off a credit card. The next is pillar number 3, inquiry account. This is something that most people online talk about incorrectly. Anytime that you apply for a credit card or a loan, you're going to be hit with what is called a hard inquiry. And the hard inquiry is basically a mark on your credit report that lets other lenders know that you went ahead and applied to that first lender. And now each hard inquiry is only going to decrease your score about 2 to 5 points each, but too many hard inquiries in a short period of time signify to other lenders that, hey, this person is kind of hungry. This person is being greedy right now. Why is he applying to Bank of America, Chase, Wells Fargo? And you're kind of seen as a high risk. And ooh, look, I'm trying to tell you, lenders do not like to see a high risk. But look, by understanding this is where strategy comes in. This is where the good become great. We have to understand that different lenders pull different credit bureaus. Some lenders only pull TransUnion, some pull Experian, and some pull Equifax, and then some pull all three. So look, if you're strategic about it and know which lenders pull from which credit bureau, you know what lenders to be able to go to and which ones to avoid. So let's just say you have about 6 or 7 hard inquiries on Experian and you want to go get more funding. Of course, you don't want to go to a lender that only pulls Experian because they're going to be looking at your Experian credit report and seeing a whole bunch of inquiries. You probably want to go to a lender that only pulls TransUnion or Equifax, where they're only going to see little to no hard inquiries. Because by applying to that one lender that pulls some Experian, you're probably going to get an automatic denial no matter what your credit score is. And the same thing works vice versa. If you have a whole bunch of inquiries on Equifax, you want to find a lender that only pulls Experian and TransUnion. And the same thing for TransUnion. So at this point, I'm sure you're picking up what I'm putting down. Understand which lenders pull which credit bureaus and understand how many inquiries you have on each credit bureau on your own credit report. So that's why it's so important you pull a tri-merge credit report that pulls TransUnion, Experian, and Equifax line up side by side, and looking at your credit report, knowing how many hard inquiries you have on each credit bureau before you actually apply. Pillar number 4, clean your credit report fully before you actually apply. And look, I'm going to be real with you. If you have any charge-offs, collections, repossessions, bankruptcies on your credit report, especially within the last 2 years, I wouldn't go apply for funding. It's just going to be a waste of your time, man. Especially if you're going for funding where they're not looking at your business revenue and just looking at your credit report. I wouldn't even spend any time doing that. Before you apply for any type of funding, it's so important you pull your credit reports beforehand. My favorite credit report sites are Identity IQ, MyScoreIQ.com, and Smart Credit. So now look, once you pull your credit report and you see negative items, I don't want you worried about it, because I always tell people this: your current situation is not your final destination. And anything on a credit report could always be deleted or reversed. And I don't care what people say, you do not have to wait 7 years for them to naturally fall off your credit report. And you can take matters into your own hand and use the Fair Credit Reporting Act, also known as the FCRA, to remove and dispute negative items off your credit report. Generally, the Fair Credit Reporting Act is a set of laws that govern how all the information on your credit report is supposed to be reported. And one of the laws states that everything on a credit report must be 100% accurate, 100% complete, and 100% verifiable. So if anything on your credit report, including those negative items, are not 100% accurate, complete, and verifiable, you have a right to dispute and get it removed from your credit report. And look, you'll be surprised. 90% of these accounts on your credit report have some type of inaccuracy that you can dispute. Learning how to dispute charge-offs, collections, bankruptcies, repossessions of your credit report is outside the scope of this video. But if you want more information on that, let me know in the comments somewhere and I'll create another video on specifically how to get those items deleted. And before we move on, if you found any type of value in this video, go ahead and like and subscribe to be able to support this channel so we can be able to give out more of this value and information so we can go ahead and get this funding, y'all. Pillar number 5, this is the overall age of all the accounts on your credit report and also your credit mix. These two factors combined make up about 25% of your overall credit health. So this is not something to skip over. Your credit age is the overall average age of all the accounts on your credit report. The older your accounts are, the older your average and the healthier your credit report is. Because look, when you go to a lender, they're going to be looking at your credit report. They want to see long payment history on these accounts. They want to see a strong track record of you being able to pay things on time and not having them closed out. And so it's kind of like if you had a 10-year friendship with somebody and they've always borrowed money from you, but they've always been able to pay it back. Now, if they've always been able to pay you back, wouldn't you have a strong trust that if you lent them again, they're going to be able to pay you back again? Probably. But now let me compare it to your other friend where you've known them to borrow money and kind of run off on the plug, or they're not communicating, or they pay things back late. You're probably not going to lend to them. You probably wouldn't even give them $5, $10, $15 because you don't want to have to go through that risk of not being able to get your money back. That's the same way how lenders look at your credit report. So that's why it's best to never close out credit card, because if you close out a credit card, not only are you losing that account, but you're also losing all the history that came with that account. And now because you lose that account, your overall age is going to decrease as well. So the best thing you could do is to pay off that credit card, use that card to pay off a monthly Netflix or Hulu or some small subscription, set it on auto pay and put it in the back of your drawer. And look, just leave it there. You ain't got to use it. But also you don't want it to close out due to inactivity. You also don't want to close it out yourself. Now, credit mix is about having different types of credit accounts on your credit report. We're talking about revolving accounts, installment accounts, personal loans, auto loans, lines of credit, open accounts, rental accounts. Having a good mix of accounts on your credit report is going to show a lender that you can actually handle different types of credit accounts, because different types of credit accounts are going to require different types of payment strategies. If you're able to handle all those credit accounts well, the lenders are going to trust you. You want to avoid only having credit cards on your credit report and not having installment loans, and also on the vice versa, only having installment loans and not having any type of revolving accounts. You want to make sure that you have a mix of both. All right, this is the last pillar, y'all. This is pillar 6. This is banking relationship. You see, look, having a good credit score is cool. Having the right limits and having no derogatories on your credit, man, that's all great and dandy. But that is not the full picture. The real question is, what banks know, like, and trust you? What type of relationships do you have with lending institutions? When a bank already knows you, you got deposits running through a bank account, you're using their products, and you've been with them for an extended period of time, when you go apply for any type of funding, best believe they're going to give you a bag. Now, I wish I could, but I can't tell you the exact bank is perfect for you, because every person is different, every business is different, and everybody has their own needs. But I will tell you this: having a strong relationship with a bank or a lending institution before you actually apply Can be the difference between getting approved for $5,000 and getting approved for $25,000 off your first business credit card. Yes, I can't tell you which specific bank to go to because it all depends on your relationships. But I can tell you that not all banks are made the same. There is a tier system. There are some banks that have a higher priority compared to others. And by priority, I mean they have a little bit more respect in the funding game. So now let's start off with the tier 1 banks. These are the must-have banks. Now these are the big boys. This is Chase, Bank of America, Wells Fargo, American Express. Your goal is to have at least one product from them. That could be a credit card, a line of credit, a loan, an auto loan. Preferably you want to get a revolving account, so that's a credit card or a line of credit. And on that line of credit, you want to have at least $5,000 to $10,000. Having a revolving account of $10,000 or more is just going to give you a little bit more weight when it's time to get funding from another lender. Now, tier 2, these are the good to have banks. These are the Discover, Citibank, US Bank. These banks add a little bit more depth to your profile. Now, they're not going to have as much weight as a tier 1 account, but it's still good to have on your credit profile because the lender is going to see they have multiple relationships with multiple lenders. And now finally, tier 3, these are the banks to avoid at all costs. These are the credit ones, the First Premier. These are the store cards. Just generally any type of bank that has a first or a one in its name, I try to stay away from those. And here's why. People with bad credit, people who can't get approved for higher amounts, or people who have been struggling financially are typically the only ones who go off and get these accounts because these accounts are dedicated to them. And these cards charge high interest rates, they have terrible terms, and they give out small limits. So if you try to go to a tier 1 bank and they look at your credit report and see a whole bunch of these credit ones, Premier ones, First Premier, all these little junk cards, they're going to assume that you are just now getting off of bad credit or you have bad credit, and they can't approve you for anything because you don't have anything on your credit report to show that you can handle a higher amount. Because lending institutions are going to use what is called a comparable credit, meaning they're going to look at your credit report, determine what they're going to approve you based on what you already have. So if you got a whole bunch of $500 accounts or $1,000 accounts, really, if you do get approved at all, they're only going to give you like $5,000. Shoot, you can't really get jiggy with $5,000. Here's the general rule. 80% of all accounts in your credit report should be comprised of tier 1 banks and tier 2 banks. So now look, if you watch this full video, you're already ahead of 90% of the people who go out and apply for funding and get denied and don't know why. At this point, you now see the importance of building out a strong credit profile for maximum funding, and it's not an option anymore. I'm trying to tell you it's the difference between getting approved and getting overlooked. I've used these same strategies to be able to help one of my clients A's get approved for over $100,000 with only 3 products. Or where I've helped Eric and Anna get approved for over $240,000 for their transitional housing business, even when they first started off having damaged credit. Or where I've helped my other investor client, Darlington, remove late payments, delete hard inquiries so that he can get over $70,000 in 0% interest business credit and lines of credit to invest in his out-of-state investment properties. So if you're serious about getting access to capital the right way, go ahead and click the link in the description, book a free strategy call so we can come up with a customized game plan just for you. And look, if you found this video helpful, don't stop here. Go ahead and watch this next video where I break down exactly how to delete hard inquiries from each of the credit reporting agencies fast and in a hurry. Go ahead and click somewhere around this video and I'll see you on the next one.